Good afternoon, ladies and gentlemen, and welcome to 361 WAM's Q1 FY24 earnings call. As a reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions after the management shares their thoughts. Should you require assistance during the conference, kindly signal the host by tapping on the raise hand icon. Please note this conference is being recorded. On the call today, we have with us Mr. Karan Bhagat, Managing Director and CEO, Mr. Anshuman Maheshwari, Chief Operating Officer, and Mr. Sanjay Wadhwa, Chief Financial Officer. I now hand it over to Sanjay to take this conference ahead. Thank you.
Thank you, Anil, and a very good afternoon to everyone on the call today. Public market sentiment saw a significant improvement in Q1 as against second half of last financial year. The benchmark indices touched all-time high, boosted by strong FII flows and encouraging market indicators. The global risk and growth continues to remain cautious on the back of uncertainty related to global central banks' policy updates. However, India, with its strong domestic drivers, is expected to show continued resiliency and growth recovery. On the current quarter at 361 WAM, a diversified portfolio mix, healthy net flows, and our focus on recurring revenue streams continue to hold us in good stead. We saw growth across key matrices such as ARR, assets, net flows, retentions, which led to strong rise in profitability. The business and financial performance is in line with our FY24 guidance. Before we deep dive into financials, we would like to highlight that we have announced an interim dividend of rupees 4 per share. This is our second interim dividend for this fiscal, taking the total dividend to rupees 8 per share. Now, coming to the financials, starting with AUM, in line with our focus on ARR assets, the total ARR AUM increased to 191,390 crores, up 33.3% YOY. This growth was driven by strong net flows of 12,975 crores during the quarter. Our wealth ARR AUM stood at 1,26,285 crores, up 42% YOY, while AMC ARR AUM stood at 64,105 crores, up 20% YOY. As noted in all our previous calls, our focus remains to increase ARR assets and high-quality revenue generated from them. Now, coming to revenue and retention, our recurring revenue increased by 7.1% YOY and 15.5% quarter-on-quarter to 323 crores. As a percentage of operating revenue, recurring revenues now comprise 80%. As stated in our previous call, we have now moved to accrual method of accounting for carry income. The accrual is based on conservative fair value estimates of the carry income in the funds which are close to maturity in the last 18 months of their life cycle. The carry income is now included in the recurring revenues. During the quarter, we have accrued 40 crores of carry income. To reflect this change, we have restated the numbers from the previous quarters in our Q1 disclosures. This change will bring in steadiness and predictability in carry estimations. Hence, just to repeat, the carry income is now part of ARR revenues. Our total revenues for the quarter were up 17.6% YOY and 12.7% quarter-on-quarter at 434 crores, driven by growth across business segments and higher other income. Our retentions on ARR assets have remained strong at 73 basis points as against 70 basis points in Q4 FY23. The wealth ARR retentions being at 70 basis points and asset management at 80 basis points. Now, coming to expenses for the quarter, operating costs rose by about 25% to 210 crores for the quarter due to strengthening of sales team and some higher marketing and sales promotion expenses. Cost to income ratio stood at 48.4% versus 48% in Q4 FY23. We expect this to moderate over the year as the current quarter included certain one-time marketing expenses. Coming to profitability, PAT stood at 181 crore, an increase of 13.4% YOY and 16.9% quarter-on-quarter. Importantly, our tangible return on equity, which is ROE excluding goodwill and intangibles, continue to remain strong at 28.6% for the year. This is a result of prudent capital management and regular dividend payouts. With that, we come to the end of financial highlights. I will now hand it over to Anshuman to cover key business and strategic highlights.
Thanks, Sanjay. Good afternoon, everyone. The last 4 to 5 quarters have been interesting for the industry as well as us, both in terms of equity market movements and business trends. In this period, 361 WAM has been able to showcase agility, resilience, and steady growth in contrasting periods of weak momentum, as well as new market highs. We strongly believe that we have significant growth opportunities given the outlook on India, as well as our leadership positioning in select business segments. The competitive moats that we have built through our sharp focus on wealth and asset, leading proposition, deep client relationships, continuous product innovation, and robust risk and governance position us uniquely for the opportunities ahead. Accordingly, as you would have seen in this quarter's investor deck, we have provided a summary of our view on the medium to long-term assessment of the addressable market opportunity and our focus areas. On wealth, we see a USD 1 trillion market opportunity, doubling over the next 5 years. Firstly, our core wealth proposition focused on the UHNI segment is an $800 billion US dollar market across 30 to 35,000 households currently. The growth in wealth is expected to be the highest in this segment, combined with increased professional wealth management penetration. Our focus for this segment remains on first, deepening our current relationships and increasing our share of wallet of existing and future wealth of these clients. Secondly, continuing our geographic expansion across domestic cities, as we expect this phase of growth in wealth to be far more dispersed across India. Third, selectively expanding in offshore locations, as we expect a global presence to become increasingly important for this segment of clients. And lastly, continuously sharpening our advisory proposition and product platform to cater to the emerging client requirements. The second aspect of wealth management, our ability to address the next segment of HNI clients, opens another 160 to 170,000 households for us. We are excited by the prospect of being able to take our sharp and unique wealth proposition and all the strengths of our current platform to this segment of clients. The business build, including significant digital developments for being able to address the requirements of these clients effectively, is progressing well. And we are on track for going to market towards end of Q3, beginning Q4 of this financial year. On asset management, India remains a relatively nascent market with tremendous growth potential. At about $600 billion US of AUM, we are only at about 15 to 20% of GDP, while the global average for asset management AUM is 70% plus of GDP. Specifically for us, at over $7 billion AUM and with a high single-digit market share, we have unparalleled leadership on the alternates space in India. Our build out in each key strategy, which includes listed equities, private credit, infra, and real estate, is playing out well with strong traction from ultra high net worth clients, family offices, and as well as increasing domestic and institutional interest. We expect alternates to remain the fastest growing segment within asset management, and we will continue to gradually add strategies and further ramp up our investment teams. Mutual funds remains an interesting market opportunity. We have successfully built out selective equity products with strong, sustained top decile performance, and will continue to be on the lookout for differentiated offerings. Our distribution reach, specifically with individual MF distributors, is also getting built out well, and we maintain the optionality of growing our presence further in this market. So overall, while we have leadership presence in our core wealth and alternates business segment, and these will continue to be the bedrock for our growth in the near future, it's important to note that we have a potential addressable revenue pool of over 50,000 crores, growing at double digits annually. We are excited by our positioning and ability to tap into this expanded revenue pool, and are confident of being able to drive strong double-digit growth in AUM, revenues, and profits over the next few years. With that, I would like to open the session for Q&A, and I'll invite Karan to come on as well.
Thank you, Anshuman. To ask your questions, kindly tap on the raise hand icon. We request you to introduce yourself and the organization you represent before asking your question. Thank you. We'll give it a minute for the queue to come in. We'll begin with Presh Jain. Could you unmute yourself and ask your question?
Yeah, hi everyone. A good set of numbers. Just a few questions. Firstly, I think on the 361 plus, I think we saw very strong inflow that in this quarter. Could you highlight as to what was the differentiating factors that played out in this quarter, and is there anything specific one-off out there, or do we see the momentum sustaining there?
Thanks. So I think from an 361 plus, I think it's kind of been a special quarter for us because obviously there were 3-4 large public market listings where effectively there were a few promoters who ended up doing an offer for sale. In addition, the level of market activity in terms of secondary sales of even unlisted businesses continued to gain traction. I think it's not a one-off in that sense, but we've ended up having a fairly large kind of market share in the new wealth creation over the last quarter. And it's safe to say, I think 65 to 70% of the larger clients who ended up with a secondary liquidity event, we were able to convert in the last quarter. Having said that, obviously a large amount of the conversions have happened through the quarter. A lot of these flows will get invested over a period of time. And with some of these clients, we've not yet kind of finalized the final fee structure. So in the yield, you see the effect only of around about half of these mandates. The remaining half are going to be finalized as we speak over the next quarter or so. But yes, our general market share in conversion of new clients, especially for secondary sales, either through IPOs or otherwise, has been phenomenally high in the previous quarter.
So, Karan, is it fair to assume that the yields on this business will improve in the second half and once you finalize? Because
yes, for sure.
Yeah.
For sure. I think the yields will definitely improve. I think it's a combination of 3 things, the yields improving. One, obviously, I think close to around about 3,500 crores on our non-discretionary PMS become fee payable more or less starting second half of this year, which is effectively stocks which we are carrying in basket for the last 2.5 years, because their products done in the previous regime pre-2019, where we received distribution commissions and hence we are not able to charge any fees. They automatically become largely fee bearing from the second half of this year. 5,500 crores under advisory are not still fee bearing at all. And in addition, I think even on the remaining assets, I think we had fixed the fees slightly earlier. I think there'll be a slight bit of pickup there also. So overall, definitely, I think towards the second half of the year, not necessarily for the, you'll definitely see a largest pickup in yield. Maybe only for that quarter and subsequent quarters, the yield pickup may not be large enough to make up for the first 2 quarters, but definitely there will be a substantial pickup in yield in quarter 3, quarter 4.
Great. On the alternate investment side, like we have been discussing about, the flows should move towards credit and beyond listed equity is a space that you would look to garner higher flows. But honestly, we haven't seen any differentiated traction out there. So could you throw your outlook there?
No, actually, the traction in credit's been quite good, to be honest, in the last couple of quarters. It's just that it's got shaved off by 1,500 crore outflow on our special opportunities funds, which have come up for redemption. The funds we had raised in 2018-19, and obviously for good value, they've kind of appreciated. And broadly, I think 6,500, 7,000 crores we've collected. We've returned maybe approximately the same amount or slightly more back to clients, and we've got another 4,500, 5,000 crores to return to clients. A large part of it is happened in quarter 4 and also in quarter 1, and we've got another 2,500, 3,000 crores to return. So I think from a return perspective, I think this year we will see a little bit of pre-planned outflows in private equity. But I think in the real assets and the credit category, there'll be enough amount of inflows to make up for that. And I think supplemented by listed equity flows are expected to be substantially better in the current quarter, next quarter. But credit itself has done fairly well over the last 2 quarters, including credit and real assets. But it's been a little bit offset by the automatic redemption in the special opportunities funds.
Okay, there's a couple of bookkeeping questions. Firstly, the restatement is restatement of the carry income. That's only there in the AIF piece and nothing on the PMS, right? Is the understanding correct?
Yes, that's correct.
Okay. Secondly, on the employee cost front, we saw. So, is this a sustainable rate?
Sorry, on which one?
Employee cost.
Employee cost is sustainable. That's pretty much as per budget. I think we've been 5-10 crores over budget on the admin side. We had a large employee event for the first time after COVID, and we had a 15-year completion, so we had a large employee event, and we also did a similar client event in Q1. So it's kind of that's added to around about maybe 5 to 6 out of that 10 crores. And the remaining 3-4 crores was driven by specific tech initiatives. But outside of that, it's pretty much in line. Not really something which we're really concerned about showing up every quarter.
Okay. And lastly, is there any beyond the reclassification on the carry income? There is no other reclassification across the P&L statement, right?
No, and carry reclassification also has an impact on a Q-on-Q basis of around about, or rather on a year-on-year basis, the impact will be fairly negligible. I think last year our carry, if I remember correctly, was around about 82, 85 crores. I think the amount will be fairly maybe 10-15% higher. So it'll be around about 100 for the entire year. I don't expect to be dramatically different from previous years.
Okay. And no change in targets, right? Which we highlighted for FY24. No change there, right?
No, as of now, pretty much as per plan. Don't see any reason for any change. I think the only thing which we would kind of be a little fungible about 75 odd crores without a change in the headline and the bottom line number. 7,500 crores fungibility between ARR and TBR will be there. But outside of that, I don't see any change in the headline, top line and bottom line.
Thank you. Thank you so much for all the answers.
Thanks, Presh. Next in line, we have Jolion Lu. Kindly unmute yourself and ask your question. Jolion, could you unmute yourself and ask your question? Okay. We'll get him back on the line.
I think he's on mute.
Yeah, he's on mute. So I'll request Bhavin Pandey to come in. Bhavin,
Yeah,
kindly.
yeah. Sure. Hi. I hope I'm audible.
Yeah, Bhavan, you're audible.
Sure. Thanks. Thanks for taking my question. Just wanted to understand what would be a guidance on this cost to income going forward. As Sir mentioned that it might come down a little more. So how much are we looking at?
It'll be in the same region for 43.5, 44 to 45%, yeah, like we guided.
Okay. And secondly, as we mentioned that, we had strong inflows because of the large listings, OFS by promoters and benign secondary market. So can you give us the breakup with the 120 billion inflow that we had? Out of that, how much was this?
Around 70%, yeah. 72% would be this. 25-28% would be transfer of accounts from other wealth managers and increase in wallet share.
Okay. And just one last thing, as we mentioned that mutual fund is an interesting opportunity and the performance has been in top decile, but aren't we concerned about yields as compared to what we have in our alternate space?
So I think, Bhavan, what we've done on the mutual fund space, as of now, we've been conservative in our distribution payout to our distribution partners. We've kept the yields kind of retentions closer to the 50 basis points even for our mutual fund business. On the PMS side and alternate side, obviously, is closer to the 80 to 90 basis points. And I'm just talking about listed right now. And on the SMA side, which is the larger institutional mandates, it comes off to around about 35-40 basis points. So I think as a combination of these three, I think we'll continue to try to be around the 65-70 basis points. And we are in no hurry to grow on the mutual fund side by sacrificing yields and retentions. We are fairly confident we'll be able to grow steadily there with decent performance at the 45-50 basis points retention. Alternates PMS will continue at the 75-80 basis points and the institutional mandates at 40. So I think The listed space on a combination of these three will continue to be in and around the 65-70 basis points.
Okay, and just one last thing, how do we sort of, over the next 5-year period, look at our sales force expanding, the relationship managers that we're looking to add?
I think it's a great question. I think, I'll try and kind of give an as comprehensive an answer as I can, but some things keep evolving. I think of our relationship managers, sales force, I would kind of divide it largely between three big verticals. I think the first large vertical really is. Sorry, I can hear somebody. So one large vertical is largely going to be for the lack of a better word, the senior private banker. The private banker who has the ability to originate and manage large clients on an advisory asset allocation basis, and pretty much could manage his own book. He's in some cases assisted by a couple of junior bankers, or in some other cases, he also runs a team of 5 to 6 junior bankers. I think these individuals in our system are close to around about 60 to 70, and make up or rather 70 to 75, and make up the core of our wealth management business in terms of origination of large clients. The second set are essentially relationship managers so this team, including the junior bankers, for the lack of a better word, some of the junior bankers are obviously very senior with 15-20 years experience, but I'm just talking from a role perspective. This would make up around about 160-170 people across the firm for us. We have another 60-70 bankers who are currently, let's say, relatively slightly fresh, more focused on the distribution part of the business, and may not have the seniority or the expertise to be able to manage clients on a broad asset allocation or advisory basis. I think those clients, those as relationship managers today as we speak, will play a very pivotal role for us to expand our mid-market stroke high net worth business as we go along. And third, I think where we need to really add to our sales forces on the asset management side. I think we've got a really good experience, feedback, and response for our set of products and ideas across the board from individual mutual fund distributors or others. And we have a lot more confidence in our ability to have external facing distribution partners. Therefore, we need to expand our sales team a bit. We are only around about, if I'm not wrong, 20 to 22 people on the asset management side. We've kept our sales team very, very tight and conservative in building out our AUM of 65,000 odd crores on the asset management piece. I think that's something which we'll look forward to expand as things go along over the next 6 to 12 months. So if I look at the sales team, I think these are the three places which we'll kind of build out, and I see expansion in all three. Having said that, the profile of people along with their strengths and capabilities which we are looking at recruiting across these three verticals are quite disparate and quite unique in their own ways.
Okay, that was pretty much helpful, Karan. And just one last thing before we can close. The guidance stays intact for yield blended?
Yeah, I think, as I said earlier, I think the guidance I'm quite comfortable with. The only thing I would say is, depending on the pace of the ARR and the adaptation of fees, I think approximately 7,500 odd crores, maybe 75 crores, swap between TBR and ARR might happen, but that's really a function of the pace of flows and the quantum of flows between 75 to 100 crores, but outside of that, pretty much in line.
Wonderful. Thank you. Thank you so much. All the best for quarters ahead. Thank you.
Thank you.
Thank you. Next, we have Mohit Mangal online. Mohit, kindly unmute yourself and ask your question.
Yeah, hi. Congratulations on good set of numbers. I've got 3 questions.
Thank you. Sorry, Mohit, I couldn't hear you.
Yeah. Can you hear me now?
Yeah, I can hear you now.
Yeah. So I got 3 questions. First is, if I look at your PP, you have included a new line item, the registered investment advisors, RIA. Okay. So basically that has, increased from 214 billion to 345 billion. So wanted to know, if I have to bifurcate between the NDPMS and RIA, what would be the number?
Do you have the exact number? I think it'll be approximately 60% would be NDPMS, 65%, 35% would be RIA. But what we've done, Mohit, is something slightly different. So now a lot of the new advisory wealth clients are also coming on the RIA. So these are essentially clients on RIA who are coming in a similar format to NDPMS, which is consult. The kind of clients who are coming in RIA on the corporate treasury side, we started reporting them separately because they really come at a very different yield from the core wealth business. So the second line item outside of the engagement being NDPMS or RIA really has no impact either from a yield perspective or from a segment of client perspective. So both are exactly the same.
Okay, so because if I see NDPMS is earning around 20 bits, and if I'm not wrong, historically we used to earn around 35 basis points on that. So are they coming at a discount?
No. There's nothing to do with pricing. It's just a function of time. Both have the same pricing, same model of engagement. There's really no difference between the two. There's no difference on account of pricing, whether somebody's coming on NDPM or somebody's coming on RIA. It's just that we started with NDPMS and now we started taking clients on RIA also. That's the only difference. And the reason there's a difference in yield is what I said earlier, because the newer clients who've come in the last quarter, around 5,500-6,000 crores. I think 5,600 crores exactly have not yet frozen the fee structure. That's the only difference. There's no difference in yield because of the engagement model being RIA consult. Both are exactly the same.
Perfect. Now,
the only difference is the corporate treasury, which we've taken out as a separate line.
All right. And if I look at the discretionary PMS within the 361, that has remained flat. So is there any outflow in that?
There's an outflow in that. There's one single client who had around about $100 million. There's an outflow. Outflow is not really an account of either performance or anything else like that. The client needed liquidity for one of his businesses, so it's we expect it to come back over the next 6 odd months. But there is an outflow of 100 million there. Yeah, slightly more than 125 million there.
125 million. Perfect. Now, coming to alternative flows, I think we saw this quarter having around 600 crores of flow. And if I look at 7 to 8 quarters, we saw pretty uneven kind of data. Some quarters we have 500 to 600 crores of flows and some at a kind of a flows within this alternative space.
Actually, to be fair, the flows are not that patchy. What is patchy is the outflows. Maybe from next time we'll start reporting gross sales and net sales, because if you see the gross sales numbers, they're quite consistent. I think what becomes slightly patchy is the net sales because of the outflows happening only in a few quarters without happening in the other quarters. So I think a couple of quarters through the year have outflows because of maturities and redemptions, and for that specific quarter, the net flows look slightly tepid. But I think from a gross flows perspective, it's been pretty consistent every quarter.
Perfect. My last question is towards the transactional revenue. So if you see, we earned around 82 crores this quarter, and that considering the market was pretty good, do you think, the syndication income lagged this quarter?
No, so Mohit, I think we are making a conscious effort to try and move as much income stream as possible from even the syndication income and trying to see how they can be converted into package products, pool ideas, which last over a longer period of time. As from our side, I think the effort will be sequentially over a period of next 2-3 years, all things being equal. I think to try and reduce this bucket to the minimum possible, which would mean not, that there are certain forms of income which can only be booked in the form of brokerage and upfront transaction fees, which I think would be around about 200 crores a year, around 50 crores a quarter. The rest, obviously, I think depending on how you package the product, how you format it, how you kind of offer it to the client, it can be potentially turned into long-term income. So I think our effort perpetually is to try and move everything outside that 200 crores into a longer-term engagement with the client. Having said that, obviously we will continuously balance the requirements between the two. So I think all things being equal, I think that number is unlikely to exceed 375-400 crores for the year. and unlikely to be below 300 crores. But that's the number. I think in a span of maybe 12 to 24 months, unless we start some new business in terms of a business which kind of contributes to transaction income. I think on the current set of businesses, I think 200 crores as a long-term transaction income, provided we can shift the rest to long-term annuity, is the place we would want it to be here. But that's not something which is immediate. I think where we are right now, I think the right number is going to be between 80 to 100 crores a year. I think from a 3-year perspective, potentially we'll see the same income as 50 to 60 crores. And we should want the remaining 40, 50 crores also to be turned into annuity income.
Perfect. Thanks and wish you all the best.
Thank you.
Thanks, Mohit. Next on line, we have Anirudh Agarwal. Kindly unmute yourself and ask your question.
Yeah, hi. Thanks, Pran. So first one was on our own asset management side. So, we've spoken about the expected outflows on the private equity side, but on the listed equity side, do you now see flows resuming with the market performance? So first quarter, there would have been some profit booking, etc. by certain clients. How do you look at the outlook on the listed side going ahead?
Actually, sorry. Yeah.
Yeah, and secondly, just to close on the own asset management side, do you see opportunities for on the private equity side also opening up later half of the year with this kind of sentiment?
No, I think quite bullish on both. I think we are already seeing lots of positive tailwinds on the listed side, especially given the performance of all the three products, which are pretty much ranking among the top 3 schemes in every category. So I think listed, you'll definitely see a fairly large pickup in flows over the next 3 to 6 months. On the private equity side, obviously, I think we had a fairly good year last year, where we ended up collecting a largish chunk of money last year and towards the quarter 4 of the year before that. We typically need to give it a 12 to 18 month breather, because we need to invest at least 60-70% of the money we've collected before we can go out to the market for a new large fund. I think quarter 3 is the time where we can really go out to the market for a large fund. That's really when I think quarter 3, quarter 4 is when the flows on the private equity would pick up. But listed equity, you'll start seeing definitely largish improvements in flows from this quarter itself.
Got it. And where would we be on the institutional mandates that we were targeting on the listed equity side?
So I think we are in late stage of discussion with a few. I think we missed a few on account of pricing. I think not really on account of selection or performance. I think it's a fine balance between pricing and getting the right mandate. Obviously, with our existing 4 large investors, we have a commitment not to go below a certain price, and we are going to stick to that. Within that mandate of having the right price, I think we're in close discussions with a couple of institutions. I think over this period of next 9 odd months, we would expect at least a couple to come through here.
Got it. Just on the cost side, I mean, could you quantify what part of the employee cost increase was salary increments versus, just the cost to roll out the new team?
I think it'd be half broadly, into just the delta of the increase.
So 10 crores odd would be the new team.
That's right. Approximately, I think 10 and 8 would be the right. That's broadly the right number.
Okay. And just to reconfirm, on the admin cost side, essentially, we'll broadly stick to our guidance for this year.
I think maybe 10 crores off or 15 crores off, but not 10 crores a quarter off. So effectively, what we had as 200 might end up at 210, or maybe maximum 212, 213, but unlikely to exceed beyond that. Yeah.
Got it. And last question was on the cash balance. So we will have certain cash balances that get released through the course of this year, right? The money that was invested in our own AIFs. Essentially, any plans on that? Anything on the inorganic side? I know we've made a couple of small ticket sort of acquisitions or taken some stakes, but anything that you're seeing?
Honestly, nothing immediately. So our hypothesis on acquisitions typically has been around saying that they should definitely add a new segment or a client base which we can't go after otherwise. Honestly, I think we believe that given our entire product depth, and our ability to add people across 8 or 9 times out of 10, we are able to get access to the client. We really don't want to spend too much money on acquisitions to get that access too fast. I think we're able to get there. Having said that, we would want to kind of make some bit of investments to see how to kind of cement our franchise a little bit more in some areas and some specific cities, but it's more likely to be through acquisition of teams rather than acquisition of businesses. I think we would also need to invest a bit in building out a little bit of our sales teams in Singapore and Dubai, because those two markets are kind of emerging as very, very large Indian hubs in that sense. So while our domestic and investment expertise will continue to be focused on India investments, our ability to have some bit of an outreach in these two locations will also become important. So though I really won't call it acquiring a business, I think we would end up investing a bit in terms of acquiring the right teams to build platforms, both in some cities as well as in a few overseas locations, specifically Singapore and Dubai.
Got it. Just on the other income, the 30 crores other income is just the mark to market, or is there anything else?
No, just the mark to market. Yeah.
Okay. So is there a case wherein other income this year would be materially higher than the 30 crores that we guided for the full year, or most of it is in now?
All things being equal, if markets are broadly at similar levels, I think we might end up with a slightly higher number. We might end up with 70-80 crores. But just from a conservative perspective, there's really something out of our control. So we've kind of modeled at 30 to 40 crores. But yes, all things being equal, might end up at 70 to 80 crores.
Got it. Thanks a lot, Karan.
Thank you. Next in line, we have Abhijit Sakare. Abhijit, kindly unmute yourself and ask your question.
Hey, hi everyone. So first question, so helpful slide on the HNI mid-market numbers. So the question was that seems like from the commentary, we've been gaining good share on the ultra HNI side. So looking out, let's say 3-5 years, what's your sense on the kind of growth we can deliver from this space itself? And then further on, how are you looking at uplift to growth numbers coming from the mid-market side?
So I think in that sense, I think there are three factors really. I think and that also kind of comes out clearly in that slide. First, I'll refer to the 30, 35, 40,000 people on the ultra high net worth side, right? So I think my sense is obviously we have active wallet share from around about 2,800 to 3,000 families on the ultra high net worth side. My sense is we are in touch with another 3,500, 4,000 of these families. So I think we have a sight to around about 15 to 20% of this client base, and maybe potentially a market share of dealing with 6 to 7% of this client base. Now, obviously, from a tailwinds perspective, there are three things which are happening here, right? So obviously, the growth of wealth of these set of clients is slightly disproportionate compared to the rest of the triangle. So we see wealth for these clients itself maybe potentially grow by 10 to 15% as opposed to the 7 to 8% growth across the broader economy. Second, I think, and the second parameter which I'm saying right now is maybe the most important. I think acceptance of having professional wealth managers is definitely on the rise. I think we would put that number closer to maybe half the set of 35-40,000 people. I think, but that number is going to progressively increase definitely. Therefore, that kind of increases our coverable market base in that sense. And third, obviously, is our own ability to increase our market share, both in terms of new clients as well as in terms of wallet share. So I would like to believe if the base level growth is 10 to 12% multiplied by half, which is effectively the reachable client base, improve that half by a little bit, and then factor in wallet share growth as well as our own market share growth. I would like to believe we should be able to grow. If the entire industry is growing at 11 to 12%, we should be able to grow at the 15 to 18% number for sure on the ultra high net worth piece itself. On the mid market, again, if I look at the current business, maybe around about 15 to 20% of our current business is really already coming from this segment, and 80 to 85% of our segment is in the ultra high net worth. So as we build out what we are calling the high net worth or the mid market segment, and we'll get to the right branding and so on and so forth over the next 2-3 months before we launch. But if I look at that segment, I think we will have a bit of a launching pad. We're not going to go into it absolutely blind, both in terms of sales teams as well as in terms of the investment understanding, as well as in terms of the tech we built over the last 12 to 18 months. I think we have a very good understanding of the business, as well as maybe potentially having another 3,000 families we are already kind of dealing with in that segment. So I think, it's too early for me to kind of project out numbers there. But I feel very confident about our brand, or about our ability to be seen as the right wealth managers for that segment. And I think the most important vote of confidence we really have is a combination of our brand with this segment, as well as our ability to be able to map out the right set of products and ideas. So I think we should be able to make a progressive show of strength in that segment. I think we may start off slightly slow over the first 6-9 months, but I'm quite confident a similar market share of maybe potentially 7 to 8 to 10% is what we can get to over the next 3 to 5 years in that segment.
Thanks, Karan, for that. Just a small follow-up on the mid-market side. I think what we're picking up generally is that it seems like the product platform has a lot more importance on the mid-market side.
Yeah.
But parallelly, the challenge also seems to be that it's also tougher to get the right RMs, or probably tougher to retain them. So in that context, I mean, how are you kind of seeing this being built out?
I think it's a fair point. I think the persistency ratios for both clients and relationship managers are unlikely to be as high. It's on the ultra high net worth side. But what we see on the ultra high net worth side is practically impossible to repeat on the high net worth side, because if you see the persistency ratios of both clients as well as relationship managers, they'll be in the high 90s, right? So I think it's virtually impossible to repeat that on the high net worth side. But I think it will still be better than on the asset management business, where you see persistency ratios of the mid 80s or the late 80s for very good performing products. For products which are average, you see it dropping between the mid 70s. I think the high net worth segment will be somewhere in the late 80s or the early 90s. But I see it quite repeatable and quite in some senses having a lot of, I would say, equal weightage to products and equal weightage to access to last mile. I think on the ultra high net worth side, I would put a little bit of higher weightage to access to last mile as compared to products. So I would put it as a 60-40 ratio. Whereas on the high net worth side or the mid market side, I would practically say it's equal. We need both. We need access to the last mile, as well as we need a good combination of products. On the asset management, I think obviously it moves a little off. It goes to maybe 40% access to last mile and 60% product innovation. So I think that's the split. So yes, you're right. I think persistency ratios as well as importance to last mile will be slightly lower. But that's the opportunity for us also. If we reach, if we can get the right amount of product standardization, adoption, and distribution, along with the right set of training tools for our relationship managers, I think we might be able to bridge the divide which is there currently.
Got it. Thanks a lot.
Thank you.
Thank you. Next, I invite Dipanjan Ghosh. Kindly unmute yourself and ask your question. I now invite Dipanjan, you're on.
I'm audible?
Yes, go ahead, ask your question.
Yeah, so a few questions, Karan. Just going back to that point on RIA versus NDPMS, you have given some numbers on last quarter and this quarter. Some triangulation, and again, there can be differences in calculation based on daily AUMs or period ending AUMs. But it seems that the yields on RIA are a bit lower than the NDPMS. Or if you can, give some color on why are the clients incrementally, getting onboarded more on RIA rather than the NDPMS, and or compared to, let's say, some other DPMS or distributed managed accounts, it seems that the clients are gradually moving to more of the low yielding advisory platform. So from a medium term perspective, how do you see this really shaping up out there?
So I'll try and get you the exact numbers. Maybe I'll have it mailed to you or something like that after the call. But it's not really a function of the yields or the client wanting, more a function of our push towards on the portfolio management side having more a discretionary setup, and on the RIA side having more advisory setup. So basically, the non-discretionary portfolio management regulations and the RIA regulations are practically merged. Now, in some senses, both from a client perspective as well as a firm perspective, there's really no difference between offering the client a non-discretionary PMS platform or an RIA platform. The only thing is, in the case of a non-discretionary PMS platform, we'll have to obviously have a portfolio manager involved, and we'll have to have a second licensed entity involved. In the case of an RIA, as long as the relationship manager has cleared his advisory exams, he himself can handle the client. So preferably going on the medium to long term, we would like to onboard a non-discretionary clients on an RIA license as opposed to the non-discretionary PMS license. And clients who are giving us the discretionary mandate would obviously come in the discretionary license on the PMS side. See, globally, the RIA license actually itself covers discretionary and non-discretionary. In India, there's kind of split into two licenses, PMS and RIA. So we have to kind of have both the segments handled differently. But between non-discretionary PMS and RIA, there's honestly no difference. No impact or reason for the yield to be different, apart from the fact that our initial advisory clients effectively onboarded on non-discretionary PMS, and more or less over the last 4 to 5 months have got onboarded on the advisory side. But really no difference as you go ahead between the two yields. In terms of triangulation of data, I think non-discretionary PMS will be slightly higher. I think it would be close to somewhere between the 50 to 60% of that number. I don't have the exact number. And 40 to 50% would be advisory. The current yield on non-discretionary PMS will look higher, but that's not because of the segment or both of them being different. It's just because they were onboarded at a different time, and RIAs got onboarded more over the last 3 to 4 months. Exactly after 6 months, both the yields will look more or less similar.
Got it. Got it. Second, on your cost targets, now given that you're expanding geographically or onboarding new teams, you also plan to get some RMs or senior leaders in your offshore locations, and also the mid-market strategy. So, how confident are you on the cost trajectory, maybe from a near-term perspective?
So actually quite confident, but obviously if you end up recruiting a very large team or building out a new business altogether, I think employee cost in the region of 5 to 6% can potentially change. But those are obviously fairly large recruitment decisions, which would be immediately outside the ambit, and mostly by the time these people join, it will be towards Q4 of the current year, unlikely to happen prior to that. But outside of that, don't see any large risk to costs. But in the event of us getting some large team either on the wealth management side or on the asset management side, which is strategic in nature and allows us to build one of the newer initiatives, I think we pretty much have cost under control.
Got it. And lastly, on the product pipeline, you're given some color in 4Q. Has there been any change to that?
The product pipeline continues to be fairly exhaustive. I think on the alternate side, we've well planned for the current quarter and the next quarter because it needs around about 6 months of planning. I think on the mutual fund side, we've launched one new product of a flexi-cap fund, which has started off with a good small size of 300-400 crores in the current quarter. And on the institutional mandates, I've already spoken. On the wealth management side, obviously, we had a very good quarter last quarter in terms of distribution of new products and ideas, including mutual funds, alternates, as well as PMSs. So I think product-wise, fairly well set for most of the year. Obviously, as we go along, we keep innovating along the way. But even outside of that, I think we are fairly well set from a business plan perspective for the year.
Sure. Thank you and all the best.
Thank you. Next in line, we have Bhuvnesh Garg. Bhuvnesh, kindly unmute yourself and ask your question. Bhuvnesh, we can't hear you. I think we'll come back to Bhuvnesh. We'll move to Uday Pai. Uday, kindly unmute yourself and ask your question. Uday Pai, you could unmute yourself and ask your question.
Anil, I think he can't hear us.
Okay. Next, we'll move to Rahil Shah. Rahil, if you could unmute yourself and ask your question.
Hello, am I audible?
Yes, go ahead.
Yeah. Hi, good afternoon, Mr. Bhagat.
Hi, Rahul.
So yeah, just given everything you've spoken on, so just if you can also provide a perspective on the revenue and the operating margins for this year, like how do you see it shaping up? Broader view.
I think similar, honestly. I think, obviously, I think there'll be a roll-on effect for the full year for advisory and non-discretionary PMS a little bit. So I think yields might be 5-6 basis points lower, but I think it'll kind of get complemented with the 7,500 crores of TBR extra, which I've already spoken about. So I think that's the only change from a revenue perspective. I think all the other line items more or less remain the same. Even there, I think our AUM numbers will be well maintained. The yields will potentially take lag 3 to 6 months in terms of conversion. Operating margins again, I think pretty much within the guided numbers. I think employee costs largely in the region of the 32-33%, and other expenses largely in the region of 11 to 12%. So I think that's the broad numbers. I think 1%, 2% here or there, fungibility will be there, but approximately 32-33% on the employee cost and 11 to 12% on the other costs, and therefore 44.5, 45% on cost to income. I think that's broadly the numbers we would be looking at. Yeah.
Okay, sir. Thank you and all the best.
Thank you.
Thank you. Next in line, we have Bhuvnesh back. Bhuvnesh, could you unmute yourself and ask your question? Bhuvnesh, go ahead, ask your question.
Yeah. Hi. Am I audible, please?
Yes.
Hello. Yeah. Sorry. Thank you for the opportunity. Most of my questions have been answered. Just 2-3 things. Firstly, about our ARR inflows. So of this 13,000 crore in our ARR inflows, how much of it would be shift from TBR, and what would be net new money in the company? Yeah.
I think less than 20% would be TBR shift, or 15%. I think 80-85% would be net new flows.
Okay. And okay. So, and what would be the net new money in the company? I mean, I see some decline in our transactional AUM from 1.07 lakh crore to 1 lakh crore. So just want to understand that overall company level.
Actually, that's just a reclassification between TBR and custody. So there's no decline on the TBR side also. There were some roundabout for the AUM which has got reclassified from TBR to custody. TBR also has seen roundabout a net inflow after adjusting for that of around about 2,000-3,000 crores.
Okay. Fine. And secondly, on sir, your yield. So what would be our steady state yield in RIA model or NDPS model? So what would be a steady state yield there?
So I think steady state on discretionary is maybe 5 basis points lower than what we've historically looked at. We would still want it to be in the region of 50-55 basis points. And non-discretionary will settle down at the 35-40 basis points number. Yeah.
Okay. Yeah. That's it from my side. Thank you. Yeah, all the best.
Thank you.
So thank you, ladies and gentlemen, for joining us this afternoon. We look forward to hosting you for the next quarter results. Thank you.
Thank you.